Angel Oak Capital Advisors. Rob McDonough, senior consultant over there, has joined us in the past, and our clients have gotten a lot of benefit from hearing him talk. It's a little bit of a different conversation than some of our traditional webinars that are usually focused around real estate and some of the market trends and stuff like that. But I think this is going to be really valuable. So, as a very brief introduction, because I think Rob's presentation will speak for itself. Angel Oak Capital Advisors is a SEC registered investment advisor. They manage $5 billion in assets, and Rob was previously chief risk officer there, but has done a variety of things in his career in organizations like the FFIEC, the Federal Reserve, FDIC, a whole bunch of stuff. So he is an expert in his field, and also a friend of Mountain Seeds. So with that, I'm going to turn it over to Rob.
Great, thanks, Carl. So appreciate that introduction, and also appreciate the opportunity, as always, to be able to get in front of your network, and even if only digitally. But we like to share our story, but also hopefully today we'll have a couple of things to share that will overlap with the interests of the people who are signed up for this presentation today. So what I thought I'd start out doing is just describe the kind of conversation that we're going to have over the next 45 minutes or so, and I hope it's a conversation. I know the webinar format is not as conducive as face-to-face with regard to asking questions, but Carl and Melanie are going to be kind of monitoring, as well as I'll be monitoring any kind of questions that pop up in our little chat window. So I encourage you certainly to shoot those at me, and I'll try to respond to them accordingly. But today we wanted to talk about some collateral management issues and related to particularly real estate collateral and associated with really loan valuations and the collateral valuations for particularly non-QM loan sales and securitizations. And when I introduce Angel Oak in the next slide, you'll understand why that's particularly relevant to us. But I'll be sharing some issues that we think will make this also relevant to anyone who's thinking about where real estate and valuations are going. So just a little bit of information about Angel Oak. Angel Oak is really an affiliation of related companies, and we really have three different major business lines. One is Angel Oak Capital Advisors, and as Carl was saying earlier, Angel Oak is primarily an asset manager. The slide I've got in front of you, actually my marketing people would kill me because it says $6 billion in assets, and the last time Carl and I talked, we were managing about $5 billion, but actually we need to update that because we're up to about $7.5 billion in assets under management. And those assets are primarily real estate related and housing related. They are in the form of whole loans as well as in securities, particularly structured financial securities that are associated with those kind of assets. The other major business that we have is our mortgage lender, Angel Oak Home Loans, and they have a full suite of residential lending services. They offer conventional FHA and VA loans. But the real sweet spot for our company is what we call non-QM loans. These are what used to be called non-conforming loans from a Fannie and Freddie agency perspective, and that's what I wanted to sort of direct our conversation to today around those particular assets and the collateral associated with those and how we deal with some appraisal and valuation issues on those real estate assets. The other part of the business that I'm intimately involved in is our consulting group. We primarily work with financial institutions, including banks, insurance companies, asset managers. We also work with the Federal Reserve and other central banks around the world to primarily provide risk management consulting services. We do a lot around interest rate risk and treasury risk management, but if it's a risk that a financial institution faces, whether it's credit or interest rate or market or liquidity risk, we are there to be helpful to them. So enough about Angel Oak, and I really wanted to spend a little bit of time talking about where we wanted to go with this conversation. So those of you that may have seen the movie The Big Short are going to be somewhat familiar with some of the storyline today in our conversation, because I wanted to talk about asset securitization and structured finance with a focus on those transactions that are real estate related, and talk about how those two concepts are very closely knit to each other. And primarily wanted to start out talking about how the world has changed from the perspective of how assets are securitized, what that process looks like, especially if you compare the pre-crisis period to the post-crisis period. And I wanted to talk a little bit about the instruments that really comprise the structured finance market, but after a brief introduction on that, I wanted to really hone down on those that are really mortgage related and real estate related. And I know there are a lot of questions in people's minds, I think, about where the residential mortgage market is going, particularly with regard to the role of Fannie Mae and Freddie Mac, and also how mortgage lending regulations may impact the way that lending is conducted going forward, and of course, how a lot of these loans themselves end up in securities. We're an asset manager. We do a lot of investing, so obviously we have a keen interest in this. But one of the things that we're also very actively involved in is securitization itself. We are securitizing a number of our mortgage assets that come from the mortgage company, and we're also beginning to become an asset aggregator, which means we're buying credits from other institutions for our securitization. And we are therefore particularly interested in the environment, both regulatorily and market related for assets that are securitized. And we have to keep a very keen eye, in particular, on identifying the right kind of collateral and establishing their value. So when we think about a residential mortgage loan, for instance, one of the primary things that's going to demonstrate that asset's value is the value of the underlying collateral. And there are very specific requirements around demonstrating that value. So one of the things I wanted to share was really the key differences between what is today called a non-QM residential mortgage versus what is popularly called a subprime mortgage or a subprime asset, and how those are very different today, and hopefully dispel some myths that have grown up around that designation. And share with you also a little bit about the collateral management and valuation issues that are associated with these real estate related assets. In particular, what some of the requirements are for appraisal valuation on these assets, which is critical when you're trying to establish the value of a securitization that you're bringing to market. The rating agencies and the investment community in general has a much higher degree of due diligence requirements on these transactions than they had in the past when, quite frankly, these transactions were just slapped together. So that last piece is hopefully where we'll see the overlap between what we're doing at Angel Oak with regard to securitization, both in creating the securities as well as investing in them, and the world of real estate valuation. So let's go ahead and jump into the meat of the presentation. And just to set the stage, really, if we think about the world in a pre-crisis or pre-2008 type of an environment, really the period after 2000, if we ignore a few things like Y2K, which is kind of a non-event, and September 11, which is very definitely a significant event, nevertheless, during the pre-crisis period, the world economy was performing pretty strongly overall, or at least it appeared to be. I mean, in the developed market world, and even in the developing or emerging market world, it appeared that things were going pretty well. And part of this, at least it was believed at the time, a part of this was due to a certain amount of financial deregulation that was taking place, giving financial institutions in particular the ability to be more creative and more flexible and more nimble in the marketplace, and to engage in financial engineering of new types of products. Primarily, we saw the evolution of structured products, which is another term for basically securitization, and then also derivatives, which a lot of people sometimes refer to as the D word, because there are many headline-making examples of institutions that have gotten into trouble using derivatives, but they really flourished during this period of time in the pre-crisis period. One of the things that we saw develop primarily in the investment in the capital markets was really how investors were underwriting the investments that they were funding and that they were investing in. In many ways, we found that for certain types of investments that had credit risk, they were really outsourcing their underwriting to the NRSROs, and that kind of awkward acronym, nationally recognized statistical rating organizations, basically refers to S&P, Fitch, Moody's, and the other organizations that provided credit ratings for these investments. And a lot of institutions were investing in these, including banks and investment banks, hedge funds, pension funds. Many, investors were interested in a lot of these products that were structured in a way to make them appear as if they were relatively safe from a credit risk perspective, but had very attractive yields associated with them. And that seemed a little bit too good to be true. And I think probably, as most of us recall, that probably was in most instances too good to be true. What happened with large financial institutions in particular is that they invested very heavily in subprime CDOs, or collateralized debt obligations. These were structured financial instruments that were largely collateralized by mortgage loans, and primarily real estate mortgage loans. And these were made in an unabashed way to what we called at the time subprime borrowers, borrowers that had impaired credit or were challenged to demonstrate the viability of their credit character. A lot of the large banking institutions were also very heavily involved in credit default swaps, which is a kind of derivative instrument that was basically an insurance policy against credit risk, recognizing that many of these subprime assets perhaps had more risk than was initially anticipated. And community banks, as opposed to the larger banks, didn't have the same kind of exposures. They weren't really in the market for these high-yielding, sophisticated investments, nor were they trading in derivatives, but they did end up getting involved in investments in TRUP CDOs, which is really a pooling of debt from bank holding companies of other community banks. And essentially, community banks got reinvested in the banking system in this indirect form by investing in TRUP CDOs, and that really turned out to be an exposure to other community banks, which was largely an exposure to commercial real estate. The commercial real estate for many community banks is the bread and butter of their lending activities. When there was a general economic downturn associated with all of the events that occurred in 2007 leading up to 2008, obviously the real estate markets deteriorated, and we saw significant losses and many instances of banks becoming insolvent in that period of time. So whether you were a large bank or a small bank, you were probably in some way affected by your investment in structured credit products or securitizations. What do we see in the post-crisis period, though? What has changed? Because although it's still important to talk about, the crisis was almost 10 years ago now, and it's hard to believe that sometimes, but it's true. So what kind of environment are we in now? And right now, really a more restrained economic environment where growth is steady but relatively low, especially compared to post-recessionary periods in the past. Fed policy has really dominated what has happened in the marketplace with regard to the rate environment, and particularly given the Fed's policies regarding quantitative easing, which is the purchase of a variety of different kinds of securities to basically control the level of rates. And the low overall level of rates has had a tremendous effect on the economy in general, in the sense that it's made it cheaper and easier for many people to borrow money, but it's also resulted in very low rates and low returns on a lot of investments that financial institutions in particular have engaged in, whether that's securities in the investment portfolio or whether that's directly in real estate or real estate related assets. The returns have simply been relatively low, so there's a hunt for yield in the marketplace that continues to this day. Of course, we learned some important lessons in the crisis about credit risk and how not to evaluate credit risk, because a lot of the risk that we found showed up in the investment portfolio in the form of these subprime CDOs and other structured financial instruments where investors basically had not done their due diligence and had not understood the values that were associated with the underlying collateral assets. In most instances, these assets were some kind of real estate related credit that was associated with some collateral position in addition. So we're in a situation where interest rates are relatively low and the returns that are available on traditional investments are relatively low, and banks and other investors have been seeking higher returns, but they're cautious about taking additional risk. In particular, they're very cautious about credit risk. So what many institutions have done is basically invested in things like long-term treasury securities, which because of their long-dated nature have relatively high yields, but which don't have any credit risk. Of course, they are exposed to a rise in rates, because if rates were to increase, those investments are going to lose value very quickly, much more so especially than shorter dated investments would. But we've been in an environment for a long time where we've just thought lower for longer. That is, interest rates will remain at or near zero for a longer period of time. And every time somebody talks about the Fed raising rates or inflationary pressures putting upward pressure on interest rates, something happens and reverses that discussion. And we've seen that happen just recently with a recent drop in rates. So even with Fed policy being biased towards a move upwards, it's still unclear where the rate environment will be going in the next few years. So to hone in on these assets that I've been describing as being real estate related, structured credit is a very large asset class in terms of investments. Almost $10 trillion in securities are being traded today in that category. Now, the preponderance of that is what we call agency-backed residential mortgage-backed securities. So these are investments that are guaranteed by the U.S. full faith and credit of the U.S. Treasury indirectly through Fannie Mae, Freddie Mac, or Ginnie Mae, and a few other vehicles. There's not really any credit risk associated with those instruments. However, there are certainly risks associated with making that investment. What I wanted to focus our conversation on today, though, is around what we call the non-agency segment of the market. So on the following slide, we will see that there are $2.2 trillion of non-agency related securities. And these take a number of different forms, but they're basically pools of bank credits that have been turned into securities and are traded in the marketplace. A number of different types of securities, for instance, CMBS or commercial mortgage-backed securities. These are obviously securitizations of commercial real estate loans. Collateralized loan obligations are loans to middle and lower tier corporations, generally highly levered corporations, loans that are made to below investment grade companies that have very attractive yields associated with them, but also obviously a lot of credit risk. And there are also a variety of other types of asset-backed securities out there. There are securities that are securitized by auto loans, credit cards. Anything that is a bank credit can really be securitized and sold in the secondary markets. But for today's conversation, I wanted to focus on what has happened primarily with real estate-related bank credits. For all of the, on the following slide, for all of the different structured credit investments that are traded in the marketplace, you can see a very definite trend, particularly for the blue columns, which indicate non-agency residential mortgage-backed securities. And while all structured credit did very well leading up to the crisis period, in terms of growth, non-agency guaranteed residential mortgage-backed securities dominated the marketplace. And at one point, in fact, issuance exceeded that of the Treasury market. So it was an enormous segment of the capital markets. And then very clearly and visually, you can see that in 2008, there was a dramatic drop-off on issuance. And that meant basically that no new securities were being created, and also that a lot of the assets that were going into these securities were not being created as well. Demand for commercial real estate loans dropped off. Highly levered lending transactions for corporations were just too risky during that period of time. And the ability to make subprime type residential mortgages really became impossible for a variety of reasons. So new issuance dropped off to almost nothing. Now, just to distinguish very clearly, to point out what I mean by non-agency residential mortgage, it's important to think about the generation of these assets. So banks and other lenders are engaged in residential mortgage lending and generally focus on one of two types of credits. One, which used to be called agency conforming type lending. This is a loan to America's best borrower with very high credit standards and underwritten to a very specific underwriting box with specific requirements about loan to value and debt to income ratios. It's a very conservative kind of lending to a very high quality type of borrower. And most of these loans are pipelined into securitization structures that are sponsored by Fannie Mae, Freddie Mac, and in some instances, Ginnie Mae. These are government guaranteed transactions and essentially are credit risk free. Banks are also actively involved, or at least previously were actively involved in non-agency credit generation, which means that they're lending to borrowers that have some sort of either impaired credit history or have some sort of credit event in their past. And these would be loans that would not qualify for Fannie, Freddie, and Ginnie Mae agency securitization pools. So for a lot of banks, before subprime CDOs really took off as an asset class, these assets would sit on balance sheet, and banks would have to bear the capital costs of holding them on balance sheet as opposed to selling them into the secondary markets. As the 2000s came around, the market for these types of non-agency assets exploded in a good way, at least at the time, in the sense that there was a lot of interest in these. And given the structures that they were put into, the securities themselves ended up getting very favorable ratings from the rating agencies. One of the reasons being that these loans were collateralized by real estate property. And as anyone in 2005 would have said, the great thing about this market is that real estate prices always go up. And for a while, in fact, that's exactly what we saw. So what has really changed in the post-crisis period, and how is the world a different place? It's primarily a different place because due to legislation and environmental and market-based changes, really the concept of non-agency mortgages is vastly different from what it was prior to the crisis. And that's largely due to some legislation in the form of Dodd-Frank and other acts that have been passed or regulations that have been passed by supervisors in Congress to ensure that we don't get into a situation like we had before with the subprime mortgage-backed securities market, primarily because loans were being made to individuals that never could have repaid those credits, never could have repaid those loans. And so when we talk about non-agency mortgage origination, which is something that banks engage in as well as mortgage companies, it's just a very different world, and it's very much more constrained than that type of lending was prior to the crisis. So as an example, in 2006, you could have a no money down kind of a loan, 100% financing. Borrowers with FICOs as low as 500 or 550 or 580 would qualify for some of the most generous terms that banks and mortgage companies were providing. In terms of income verification, there was really not a great deal of requirement there. There were what we called liar loans, where you could just basically write down your income, and then that would be taken as a viable verification of your income. And debt-to-income ratios were much higher. That is, your other debts, non-mortgage related debts, could be a very much higher proportion of your monthly income, and you'd still qualify. The appraisal process was very important in this because, of course, understanding the value of the collateral was critical to feeling like you were going to get paid back, especially in the event that the borrower defaulted. And so the appraisal process was in many instances controlled by the lenders themselves, and the lenders would order these appraisals from favored providers that may have not been completely disinterested or independent in their valuations. And in 2016, the world was a very different place. There are stringent requirements that are both implemented by the banks themselves as well as those that are required by legislation and regulation that require 20% down payments for the most part. And also importantly, the ability to repay, or ATR. And we'll talk a little bit about the importance of ATR later, but essentially Congress's intent with the ATR requirement is to ensure that financial institutions were not making credits to borrowers that could never repay them. And the definition of actually what that means and what that applies to is sometimes difficult to interpret, and we'll talk about that a little bit later. But debt-to-income ratios were driven down in terms of how much other debt could represent as a proportion of your income. And also, the appraisal process and the collateral valuation process was made much more independent to make sure that the lenders weren't able to favorably influence those valuations. So that's a pretty good picture of how things are different from what they used to be prior to the crisis. And some of the things that have driven that really are the creation of the Consumer Financial Protection Bureau, CFPB, and the designation of mortgages as being either QM or non-QM, and then this whole concept of ability to repay. So essentially, if you're going to be making a residential mortgage loan, whether it is what we used to call a conforming loan that were to high-quality borrowers, or whether they were maybe loans to riskier borrowers, nevertheless, the underwriting requirements are dramatically increased and made much more stringent. So the idea of a qualified mortgage is essentially, without getting into too much detail, functionally equivalent to what we used to consider conforming mortgages or agency conforming mortgages. And these are mortgages that are approved based on their underwriting criteria to be sold into Fannie and Freddie and Ginnie Mae pools for securitization purposes, still credits to very high quality borrowers, America's best borrower, essentially. And if there's a non-QM kind of loan, there has to be a non-QM kind of loan as well. And non-QM is a relatively well-defined concept, but it's a very broad concept in the sense that there are a lot of different things that can result in a non-QM credit, or defining a borrower as being one that is non-QM. A lot of borrowers that are self-employed would qualify under this because they can't demonstrate a third-party independent verification of income through their company, or someone that had a one-time credit event. In our mortgage company, for instance, we had some experience lending to the CEO of a very successful tech firm that has IPO'd now, and he's very well to do these days, but had a bankruptcy 7 years ago. And at the time that he made his loan application, could not qualify as a QM borrower because of that bankruptcy. So while his financial condition is fine today, nevertheless, the underwriting requirements are so stringent that even a bankruptcy 6 or 7 years ago can still have a negative impact on your application and approval. So it is a very much more challenging environment to underwrite non-QM credits, but there is a way, there is a business model that is successful in terms of being able to make viable credits to riskier borrowers. And a number of companies, including Angel Oak, are pursuing that business model. So there are a lot of different things that can designate a credit as being non-QM, interest-only or balloon loans or negative AM loans, loans that don't fit the 15 or 30-year maturity box, and the different types of documentation that might be used to support that application process. One last thing about the regulations, though, in particular the requirement for APR eligibility. This primarily applies to QM loans, that is, loans that are intended to be pooled into Fannie and Freddie agency guaranteed securitizations. This is a Dodd-Frank requirement that basically says lenders have to make sure that the borrower has the ability to repay, and that means that you can't rely strictly on the existence of assets, valuable financial assets or liquid assets that could conceivably be used to service the debt. Rather, the borrower has to be in a position to demonstrate that his income will be sufficient over at least the near term to pay back the loan on just the income by itself. This is primarily a requirement of the QM mortgages, but it is also applied, and the consumer CFPB has cited a number of examples where non-QM lenders have to also demonstrate that the ability to repay is a part of their underwriting, which is interesting because some non-QM loans are what we call asset-based loans, whereby we demonstrate that the borrower has significant financial assets, and for non-QM requirements that is usually sufficient, but there's an additional requirement that also the ability to repay is demonstrated. So there are some conflicting signals with regard to these requirements that are coming from the CFPB. But in any event, it is possible to make loans in the current environment to somewhat credit risky borrowers. And yet at the same time, as you'll see on slide 12, new origination of these credits has been relatively low in the post-crisis period. And it's been a real struggle for Angel Oak and other companies involved in this market to actually find the right borrowers and get them approved under the new requirements. There are some estimates, and in the upper left-hand corner of slide 12, you'll see the size of the mortgage market, which is substantial, but which we estimate the opportunity to be in this space. So the yellow chart, or the yellow bars, by the way, indicate what's happening now, but the blue bars indicate where we think this market is going to be in 5 years from now. And what's happening with the legacy market is basically subprime borrowers that took loans out in the pre-crisis period, but are still servicing those loans, have not paid off or refinanced. That is an asset class that is amortizing down and prepaying, as we speak, and eventually will go away. So where will those borrowers then have their financing needs met? We're also seeing large growth in what is going to be called non-QM credit. So that's the new, I hesitate to use the term subprime lending, but let's call it maybe non-prime lending, and a significant increase in prime jumbo lending, which is lending to high-quality borrowers, but which exceed the asset size threshold of the agency's standards. Agency CRT is an interesting concept. It stands for credit risk transfer. They're securitizations of mortgages that are guaranteed by the agencies, Fannie, Freddie, and Ginnie Mae, but where the investors in those securities bear some proportion, although not all, of the credit risk. So as an example, an investor in a agency CRT pool might be exposed to 15% of the collateral defaulting, as opposed to having 100% protection against any credit risk. And that's a segment of the market that is expected to grow. But the upper right-hand graph tells the story, which is that to this point, non-QM origination has been very low. And what that really means is that the ability to securitize or create securities out of those assets has also been very small. So to paint a picture of what kind of borrower we're talking about in this market, there really are two major categories of borrowers, what we call just missed prime or kind of a scratch and dent lending, where maybe they just fall outside barely the underwriting box for what are considered QM loans. Based on their credit score, their FICO might be just a little bit low, or maybe they're self-employed and can't demonstrate their income to the same requirements that QM credits require. And then you have non-prime borrowers, which generally are borrowers that have a specific credit event that turns off the switch for a QM type of a credit, whether it's a short sale or bankruptcy or foreclosure. And a lot of these borrowers are very strong borrowers, and they're waiting to establish their credit histories or to reestablish their credit histories. So they'll take out a non-prime loan from a company like Angel Oak, and they'll pay a higher rate to reflect their risk characteristics. But in 2 years, their credit will have come back because they'll have taken out this non-prime loan, and they'll have some credit history under their belt with current payments, and their FICO will bump up, and then they will refi into a QM loan. But there are many borrowers that fit that box, and there's a huge opportunity for lending in this space. And if the loans are produced according to the right standards, then they can be securitized, because history suggests that when these same underwriting standards are applied, and by that I mean if we look at the history of loans originated before 2000 to non-prime borrowers, their performance has been relatively strong. If you look at the history of similar types of credits in the pre-2000 period, you'll see that the right-hand side of that slide indicates that default rates were relatively low, even amongst subprime borrowers, considering that these loans are collateralized. Default rate of 5.3% is really quite low. And this, the message here is that if we are underwriting to non-QM, non-prime borrowers in the same way that we were in the pre-2000 period, then history suggests that these loans should be strong performers and that this is a viable kind of lending. If that's true, then these loans can become collateral for securitizations. And there have been some securitizations of non-QM credits, and Angel Oak has been a leader in that, although we're not the only player in that market. But we've done a number of securitizations, including 3 recently, one in late 2016, and 2 so far in 2017, with more to come. When we securitize, we have to jump through a lot of hoops, and one of those is identifying the underlying collateral that we're going to securitize. So for the most part, we are securitizing our own production. That is, our mortgage company is producing non-QM credits that go directly into our securitizations. Some of those loans we purchase and we hold in our funds. We run a complex of public mutual funds, private hedge funds, separately managed accounts on behalf of high net worth individuals and financial institutions like insurance companies and banks. And often our investments are direct investments in whole loans. But sometimes those loans are also then securitized in pools that are sold into the secondary markets. And we've had some tremendous success with the securitizations that we've experienced so far in terms of market interest in them, and many of them have been oversubscribed. You can see at the bottom of slide 15 what some of the size of the transactions and what the weighted average credit scores were, loan to values, and also the interest rate. The interest rate on these credits is going to be a little bit higher, obviously, than to a QM or a typical prime borrower. So we're seeing coupons and weighted average interest rates of near 7%, which in the fixed income world is a very attractive return when 10-year treasuries are in the mid-2s. So, you know, a strongly performing asset base and a lot of interest from investors in these assets. If you look on slide 18, we'll see what the credit rating agencies thought about our bond. And there are a number of other examples of bonds issued by companies other than Angel Oak I could show you, but this is the one that we know about best. And it's pretty indicative of the kinds of deals that get securitized. And you can see that the preponderance of the instruments that were issued, which is the senior most class, class A1, received a AAA rating. And most of the classes were structured to receive an investment grade rating. And the more junior pieces actually were retained in our funds, which is a new requirement, the risk retention, because you have to be able to show these days that as an issuer, you have skin in the game and are willing to take a first loss position in some of these assets. But nevertheless, these bonds that we brought into the secondary market were 2 to 3 times oversubscribed. So there's a lot of interest, and the rating agencies have a much different view and very different methodologies than they applied in the pre-crisis period. Their evaluation methodologies were forced to be radically changed so that a rating from the agencies today on a new issue asset-backed security means something very different than they meant in the pre-crisis period. So to get to the meat of the conversation about how this ties to real estate and real estate valuations, when we do securitizations, we are forced to and are smart to conduct a lot of due diligence on the underlying collateral assets. We are securitizing non-QM residential mortgage loans. And there are a lot of regulatory compliance requirements in terms of how those were underwritten and the borrower's ability to repay. But one of the critical components of our evaluation has to be, what is the value of the collateral? And is the collateral there to support the value of these securities if the borrower is unable to repay on their mortgage? And so for existing loan balances that Angel Oak or another financial institution may have originated, we may be talking about assets that are 3, 4, 5 years old that have been sitting on someone's balance sheet for a while, had an appraisal at the time the loan was closed, but that appraisal is outdated at this point. So if those kinds of collateral are going to be securitized, we generally require that there's a new appraisal. But most of the assets, given that they are non-QM, are new origination, coming right out of our pipeline or coming out of the pipeline of some other non-QM originator. And we can rely, based on the requirements for securitization, on the appraisal used to close the loan because they're recent origination, but there are very stringent requirements around how those values are independently validated. And there are a couple of different routes that you can go down with regard to establishing the validity of those appraisal values, because no one wants to get into a situation where they're entirely reliant on the ability of the borrower to repay. The way that the loans are priced reflect a certain type of risk, and that risk is mitigated, and the pricing of the loan is affected by the presence of that collateral. So it's critical for us to get our arms around those values, and it's critical for us to make a determination as to whether or not we really believe the value of the existing appraisal, especially if it's a little bit dated, but even if it's recent. So based on an algorithm that we basically use, we will determine how that validation takes place. That is how we get comfortable with the value of the appraisal that is supporting the collateral value. And that independent validation usually takes one of two forms. It either is what is called the collateral desk analysis, which is basically an automated desktop type application that uses certain inputs to validate an appraisal's value or to validate a property's value. And then secondarily, a field review, which is, as we'll see, kind of an appraisal light type of an approach. But let me walk you through our process very briefly and also mention why it's so important. In fact, when I shipped over the presentation to the folks at Mount Seed today, as soon as I pressed send, across the wire came an article from Bloomberg. So on slide 18, we have something fresh from the marketplace, which is basically some information that the SEC is looking into certain home lenders that are also securitizing their loans. And these loans are really financial assets that are representing lease payments on rental houses. So very similar to the P&I that is coming from a mortgage payment, but these are actually lease payments on rental homes. And apparently the bonds or the structured financial instruments that are using these as collateral have been suffering, and it turns out that the valuations that were used were basically from broker quotes, which is kind of perhaps a windshield drive-by type appraisal, or just asking someone who is familiar with a certain market that's a broker in that region what they think the value is. Very informal valuation process. And as a consequence, the market has lost their trust in the valuation of the underlying cash flows and the ability of these cash flows to be sustained in the future. And so the SEC is actually pursuing regulatory and legal action against these specific home lenders. So it'll be interesting to see how that plays out, but it does very directly drive home the importance of having full faith in the valuation of the underlying residential real estate collateral. So what does it look like in terms of being able to take a loan and get comfortable with the appraisal? So there's a review conducted on every single loan that goes into one of our securitizations or anyone that is securitizing into the market these days. The underwriting requirements and the due diligence is really enforced not only by the rating agencies, but also by the investment community. That is, they won't tolerate a deal that does not have very strong due diligence requirements around it, having been burned so badly in the past in the pre-crisis period. So an independent entity, which we'll refer to as a securitization diligence provider, is engaged to make sure that the appraisals for every single credit in the pool to be securitized is reviewed. And that includes the age, just the integrity of the data itself, the completeness, the market conditions, and just basically everything that goes into making that appraisal determination. If there are two appraisals in the file, then generally, if those two values are pretty close and then they are recent appraisals, then the review is basically, or the appraisal is basically accepted at that point. The appraised value is accepted. But unless there are two, if there is only one, then immediately something called a collateral desk analysis is triggered, which basically means that there is an independent validation of that appraised value. And a CDA, or collateral desk analysis, is basically an analysis conducted by an appraiser, but who is reviewing the original appraisal, so they do have access to the appraisal, and would determine based on an algorithmic automated approach whether or not that original appraisal value should be supported. And the biggest driver of this, as we'll see, is basically comps for similar sales or similar underlying residential real estate, which can be the ones that were used in the original appraisal, but they also can add in additional comps if that makes them more comfortable. An example of one which we pulled and redacted from one of our loan files that are scheduled for securitization is on slide 20, and it basically shows you what the CDA evaluation was. So this is the outcome of the automated appraisal review process, essentially. And in this instance, the variance of the CDA value and the original appraisal value was 0. And you have to know that that's no accident. Obviously, they're trying to verify that value, and the fact that it comes out to be exact is not a surprise, and shouldn't be a surprise if the appraisal was conducted correctly. And most of the information is coming from comps. As you can see on slide 21, a lot of the comps that were evaluated were the same ones that went into the appraisal's value. However, the individual that's responsible for conducting the CDA is also able to bring other comp properties into the analysis as well to either support or reject the value of the original appraisal. And some other factors go into it as well. It's not all about comps. So there is some HPI-like data that is used, house price index, in type information for a particular market segment, and the index data goes down to a pretty granular level, down to the zip code level or SMSA level. So there are a number of factors that do go into supporting that appraisal value in that process. And for our securitization purposes, we compare the appraised value to the CDA value. And if those values don't vary by more than 10%, and 10% is the number that we established, Angel Oak. However, that threshold, that minimum threshold, was validated basically by the marketplace. Investors have said, yeah, we're comfortable with that level. At some point, could that tighten up to 5% or even loosen up? Possibly, but that's where it is today. And if the variance is greater than that amount, then automatically a process will be engaged, which is called the field review. And Angel Oak, as the sponsor of our securitizations, would trigger that request, which would be conducted by the securitization diligence provider, which is an independent third party. And the field review is essentially a tiebreaker, if you will, in the process between the value that's established by the original appraisal and the value that is determined by the CDA. And the field review will either support one or the other of the values, and ultimately that is the value that will be used in the determination of the collaterals that goes into qualifying that loan as being able to be put into the securitization. And the field review process, I have a redacted form here, is going to look pretty familiar. This is a Fannie Mae HMDA kind of standard form, and it looks a lot like the standard appraisal form. it is in a way a kind of an appraisal light process, in the sense that the ones that I have seen are basically a view of the property externally, a drive-through of the current market, a review of comp properties, and looking at records and sales in that relevant marketplace. What doesn't happen is you don't get a lockbox that lets you into the house and with a tape measure and a camera to look at the inside of the house and measure and make sure that there's not a meth lab or something in the house that would detract from its value. So kind of an appraisal light, if you will, but still something that should be synthesizing all the relevant market-based and property-based information into a determination of which value should be used in the appraisal process. And ultimately that valuation is established, and then the loan is placed into our securitization. And we and investors can have a heightened level of assurance that that underlying real estate value will support the value of our securitization, and that our investors will get paid back. So that process, in terms of securitization of non-QM mortgages, we anticipate, we hope, and we expect to accelerate dramatically, especially if the role of Fannie Mae and Freddie Mac and perhaps Ginnie Mae declines in the securitization marketplace. That is, if the role of Fannie and Freddie is redefined or even eliminated so that they don't play much of a role in providing agency guarantees to residential mortgage-backed securitizations, then almost by definition, all securitizations of residential mortgages will become non-agency sponsored and will require very similar types of review and analysis in order for these credits to be put into the securitization process. So our thinking around this is that the requirements for due diligence are going to be increasing dramatically because the requirements for establishing valuations in these credits, given that they're to riskier borrowers, is much more rigorous than for an agency guarantee transaction. And I think this provides opportunities for anyone in the appraisal or valuation space. So if I were in that space, I'd be watching this market to see what the trends were, to appreciate what might be happening to the demands for my services if I am an appraiser, or if I'm someone who is very interested in the determination of real estate values, primarily residential real estate values. So just briefly before I engage maybe Carl and Melanie to look around to see if there are any questions, just to summarize, we're still recovering in some ways from what happened in the pre-crisis period. There's still a hangover from all of the subprime CDOs out there, but Angelic and other lenders are really ramping up the non-QM kind of lending platforms that can then be used to provide assets into non-QM securitizations. These securitizations will contain assets that are of very substantial credit quality, while not America's best borrower, nevertheless underwritten to appropriate standards that would support a rating of AAA, AA, single A investment grade on the securities that they are collateralizing. And one of the reasons why we can feel like this assurance is being provided is because there's been a great deal of due diligence on establishing the value of the underlying real estate collateral, primarily through the review process of the existing appraisals that were created to close these loans in the first place. And we're looking forward to that opportunity to provide some business for people who are interested in valuing these real estate collateral assets, because we hope that this market obviously grows for our own purposes. But hopefully that discussion and the information that I just shared with you had value to you, maybe from two distinct perspectives. One, learning a little bit more about what's happening in what used to be called subprime mortgage origination, but which is now a very different animal, and also helping to understand how the collateral is managed and how real estate valuation is a critical component and a critical success factor in residential mortgage securitizations. So with that being said, to make sure we respect everyone's schedule, I'd like to see if there are any questions, and Carl, maybe you can help if you've been monitoring that, and Melanie.
Yeah.
And
yeah, definitely. If anybody has any questions, none have actually come in during your presentation, so probably means that the information is really clear. But love to open it up. We've got a couple minutes left, so if you've got a question, feel free to type it into your question bar there on the GoToWebinar pane. So I'll give everybody just a couple minutes. So Rob, I'll ask you a question. Do you feel like I knew you in a prior slide you said that the demand for or the supply of these types of products has been relatively low. I mean, where do you see this going in the future? Do you feel like it's a relatively obviously a big market for a lot of folks that that aren't qualifying for other types of loans, but where do you see banks opening up more to some of these products, or is it always a kind of a niche market?
Yeah, so there are two things that are really driving this, and one is that the role of Fannie and Freddie going forward is very unclear, and if their role in the mortgage markets is reduced in any sense, then essentially there won't be these agency guarantees around any of these mortgage pools, and therefore investors in any securitizations are going to have to basically be subject to all of the credit risk that the individual loans themselves represent, and will necessarily have to be doing much more due diligence on the underlying. But with regard to non-QM in particular, what is really starting to happen is that maintaining these loans on balance sheet has become very expensive for traditional lenders like banking institutions that have capital requirements, and they have to hold capital against these loans, and the capital requirements themselves are pretty stringent. So it's expensive for them to keep them on balance sheet. However, there hasn't been a mechanism for them to basically offload them from their balance sheet to deleverage their balance sheets and save on capital charges until just recently. But what we've seen in the past year is really just a dramatic acceleration in the market's acceptance for these securitizations. So if lenders have a place where they can sell these loans, they'll make more of them. What's really constrained them is that they're hitting their capacity from a capital perspective, and therefore haven't been interested in looking into how they can really ramp up this activity. But if they have an exit, that is, if they can make these credits and then sell them downstream in some way, that gives them the ability to, as in traditional lending, charge fees for origination and then sell them, hopefully profitably in some way, to some downstream purchaser. And we're starting to see banks and credit unions and other mortgage lenders and people with money as diverse as hedge funds and pension funds who are looking for these kind of loans and are greatly increasing the demand for them. So we think the production is going to increase dramatically, and that's going to also dramatically increase the need to get a better understanding of the underlying collateral values.
Sure. No, that's helpful. So a question came in. How much is it a possibility, in your opinion, that Dodd-Frank might be repealed, and if so, how would that affect the process you defined?
Yeah, so my associates like to refer to me as a recovering regulator because I was at the Fed for 12 years, and I like to maintain those relationships and have a lot of conversation with the regulatory community. And in speaking to people across the regulatory spectrum, from the SEC to the Fed to OCC to FDIC, really the view is that repealing it entirely is almost inconceivable. It's so ingrained and embedded in our banking system now, in our financial markets, and also it's aligned with what the global requirements are, as far as the international capital standards. It would be very hard for us to entirely pull back. Will there be some regulatory relief, some targeted regulatory relief, and some pullback on some of the requirements of Dodd-Frank? Almost certainly. I wouldn't necessarily say particularly in the field of residential mortgage lending, but certainly in a lot of other areas that affect financial institutions, there will probably be a relaxation of some of those requirements. But under the current administration, a lot of different things are possible. And because that is true, something as dramatic as, for instance, getting rid of the CFPB or getting rid of some of the other stringent underwriting requirements, could be a reality that I wouldn't have thought was possible, a year and a half ago. So there's a lot of uncertainty around that, but I would say pretty strongly that the likelihood of repeal of the entire act is I have heard the term almost inconceivable used.
Yeah. And then we've got a couple more minutes. I've got a question. So something that I hear from a lot of our clients, including folks on the phone, and some of the sentiment is, or the struggle that people are dealing with, is concentrations in CRE. And folks, because of a healthy lending environment, are hitting their lending limit on CRE as it relates to tier 1 and tier 2 capital. How is some of this flow into some of the securitization and taking these loans off a bank's balance sheet to free up lending? How do you see this applying to commercial, if at all?
Yeah, no, we are having a lot of conversations right now with our constituency, which is largely community banks. So we are on the consulting side of the house in continuous conversation with a lot of banks of all sizes, but our focus and our sweet spot is community banks. And one of their challenges is that they don't underwrite the same kind of credits that really traditionally go into CMBS, because usually the exit strategy for a commercial real estate lender is the CMBS market, but you're talking big ticket credits there that fit a very specific underwriting box that are acceptable to institutional investors in CMBS. And community banks in particular struggle with that and are bumping up against those regulatory capital limits for CRE lending, that magical 300% of capital number. So what is actually happening is that the investor base for structured finance is becoming more sophisticated, and a lot of ideas are being pursued both in what are called small ticket or down market commercial real estate securitization. So basically a mini CMBS kind of a product where banks that are making these and getting kind of choked up on some of their CRE can find these purchasers of the loans that are going to be putting them into non-traditional, non-standard CMBS type structures, which are often called mini CMBS. And we're not doing that at Angel Oak, but we're seeing some other companies get involved in that. And we've had conversations even with doing some of that synthetically by creating some credit risk transfer, whereby we enter into some almost credit default swap type transactions, but where some of the risk in those concentrations is transferred through a kind of an insurance policy to a third party that's willing to bear that risk. So there are a number of doors that are opening, and there are certainly a lot of investment banks that are knocking on banks' doors right now trying to sell them on some of these ideas. And we anticipate that the opportunity for deleveraging CRE concentrations is going to increase in the coming year.
Yeah, great. Well, that is perfectly at the end of our time. So we've got a couple of thank yous that came in under the question tab. So I'll pass those along. But obviously, always great to have you on the line, Rob. Thank you so much for your time and preparation. And I know it was valuable, selfishly to me, but I believe for everyone else as well. So we'll definitely follow up for the crowd with some contact information for Rob and Angel Oak, and thank you for coming on the line. Hope everybody has a great rest of the day and week.
Thank you, Carl. It's always a pleasure.
Thanks, Rob. Bye.